Welcome to Chapter 3. And in this chapter, our focus will be on business income and expenses. Now, business can be corporations, they can be partnerships, they can be sole proprietors. And all of them will have business income. What we're going to talk about really in this chapter primarily relates to sole proprietors. Later on in the semester, we'll talk about the taxation of business income and expenses relating to partnerships and corporations. So although some of the things that we'll talk about now will apply to that, the focus for this chapter will be on the individual operating a business as a sole proprietor. So here we go. An individual who is operating a business, not as a corporation or a partnership, but as a sole proprietor, will file what is called a Schedule C with their 1040. It's one of the schedules that will go with the 1040 return. And we'll hop over in a minute and take a look at what that looks like. But on Schedule C is where you report income from a trade or business. And that's really not something that is formally defined, but it must be something that is engaged in for profit. Now you think to yourself, well, if I'm doing it and it's making money, aren't I really engaged in it for profit? Maybe, but you could also be engaged in a hobby that generates revenue, but the primary focus of it is not for profit. When we will also report business expenses on Schedule C. And in order for something to be deductible as a business expense, it must be ordinary and necessary, have a legitimate business purpose, and be reasonable in light of the fees that are generated as a result of the expense. And this is a real challenging area for lots of individuals in business because, of course, any business deduction reduces your taxable income. And so small business owners are often very motivated to have certain expenses be classified as business expenses. And, we start talking about the ordinary and necessary test, legitimate business purpose. And I have had business owners come in and want to call something a business expense, and it really isn't, or it's really extravagant, and they want to write it off under the business, as they say. And, those are the kinds of things that just because you're the business owner doesn't mean that you have the ability to define what the IRS will consider a reasonable and legitimate business expense. So what can you not deduct? Personal living and family expenses. And again, as I say, this is probably the area where small business, sole proprietors try to have many of their personal expenses classified as business expenses. Just recently had a conversation with someone about how all of the transportation expenses couldn't be deductible for her only vehicle. And that you had to apportion the business use of the vehicle from the personal use of the vehicle. And she just wanted to call it all business because she did, in fact, use the car in her business. So again, just because the business owner decides that that's how they want to do it doesn't necessarily mean the IRS is going to agree. Similarly, a sole proprietor that has a Verizon cell phone account. Cell phone expenses, totally permissible as a business expense. However, when they've got the family plan that has the 3 kids and the boyfriend of one of the kids and his kids and whatever, not a business expense at that point. Certainly the owner's cell phone expense to the extent that you could tease that out of the bill and figure out which one is a legitimate business expense. But to just say that all of these people who aren't working in the business can have their cell phones paid for free and have this guy deduct it off of his bill, it's not going to fly. Capital expenditures are not an expense. And so what a capital expenditure is an acquisition of a, often a fixed asset or something that's made to improve a fixed asset. So if we have an office building, for example, and we pay somebody to plow the parking lot, absolutely a legitimate business expense. However, if we have to replace the roof, that is an improvement on this capital asset. And that's not something we can just write off as an expense. We have to treat that differently. Again, this is just an overview, but we will go much more in depth on these things later. If you have tax-exempt income, you cannot similarly deduct the expenses that were used with that tax-exempt income. And I think the example that most recently has presented itself is the payroll protection program, which was the loan program that was made available to small businesses to maintain their payroll during the pandemic. And so Congress made these loans forgivable. And so basically, this income will be this forgiven loan will not be taxable to the business. And that's all great. So the business will just exclude the amount of the forgiven loan from its income. However, these loan proceeds were used to maintain payroll. And so what the business then can't do is ignore the income, but then take the deduction for the payroll that they used from the excluded income. So similarly, the IRS has come out and said, yeah, we're not going to treat this forgiven loan as income, but you can't deduct that payroll expense that you used that forgiven income to pay for. You can deduct all the rest of your payroll. And this was something that was determined well after the PPP program was in effect. And I remember thinking, this has got to be way too good to be true. They can't just give you free money and let you still deduct the expenses. And it was probably 2 months into the PPP that the IRS came out and said, yeah, we're not going to tax the PPP money, but we're not going to let you take deductions for the expenses that you paid with that money. So the government giveth, the government taketh away. If you decide that you've got some expenses related to the sale of illegal drugs, you may not deduct that. And while that might seem pretty reasonable, now when we have the legalization of marijuana in more and more states, it is legalized for state purposes, but not for federal purposes. So the government is more than happy to tax these cannabis operations, but the expenses related to their operation are not deductible, at least based on this analysis, because they still consider cannabis an illegal business. It's not federally legal. So there's been lots of challenges around how the cannabis businesses are going to be able to operate. And I think eventually the federal government's just going to have to give in on some of this somewhere. So if you make an illegal bribe, you bribe the town planning board to give you a building permit for your new office building, you may not deduct that bribe as a business expense. Similarly, fines, penalties, things like that, you cannot deduct. If you have lobbying expenses and political expenditures, similarly, you can't deduct that. I happen to pay for dues for a professional organization that I belong to that is a national organization for consumer bankruptcy attorneys. And they have lobbyists that lobby Congress on behalf of consumers. And we are told every year what portion of the dues that we pay is considered a lobbying expense. And then I then have to subtract that from the deduction of the dues payment that I ordinarily make, for my membership in the organization. I can't deduct the portion that's considered lobbying. So settlement or attorney's fees related to sexual abuse, harassment, if it's subject to a non-disclosure agreement. So, and this is pretty interesting with all of the kind of the Me Too stuff and all of these, high earning individuals that, or companies that paid off settlements for victims of sexual harassment or abuse in the workplace and then forced them to sign a non-disclosure agreement. Well, these companies cannot deduct either the settlement amount or the attorney's fees that they paid to negotiate that if there is a provision in it that prohibits the victim from talking about the terms of the settlement or that there even was a settlement. So this is a reasonably new development, and clearly was lobbied for by victims groups. So Schedule C has multiple parts to it. Part 1 is where the income's reported. Part 2 is the expenses. Part 3 relates to inventory and cost of goods sold. Part 4 is vehicle, and Part 5 is other. And so this is probably a good point for me to stop and hop over to the actual return, and we'll talk about what these parts really look like. So the top area before we even get to the various parts is just kind of name, address. And if you are a sole proprietor, you don't necessarily need to have an actual business name. You can just use your own name. You don't necessarily need an employer identification number, although if there's payroll associated with it, you really should, because you don't want your personal social security number, which is the alternative to having an EIN, going out on your employees' W-2s. You want to try and safeguard that. So the way a sole proprietor would safeguard their social security number would be to then establish an employer ID number. And so then we get into gross revenue, returns, allowances, cost of goods sold, which comes from the second page, which I'll go to in a minute, and gets to gross income. So, this kind of looks like a little financial statement. And then part 2, we get into with the expenses. And this has, what we'll say pretty typical expenses, but a business certainly isn't limited to just these expenses. Businesses have all kinds of unique things that may lend themselves to being separately listed aside from what's here. And we'll drop down and do that in a second. But then your total expenses go here on line 28. And this gets you to your net profit or loss. Now I'm going to jump down here to the second page. Cost of goods sold. This is basically where the inventory is addressed, and again, looks very much like an income statement, and the calculation for cost of goods sold is done just as it would if you were preparing your income statement. Then we get to vehicle information, and basically vehicle expenses can be done in one of two ways. There can be a standard mileage deduction, or actual expenses can be taken, and that will be addressed more later. But this is basically just the general information about when the vehicle is placed in service and the number of miles used for business or personal, and whether or not, how you documented that. Now, part 5, if you did have expenses that didn't fall into one of the categories that was on the first page above, this is where you could separately list other expenses. For me, I tend to have a lot of court filing fees and things like that. And so I separately list those because I think it's a significant enough portion of my expenses that it doesn't really belong in a kind of a miscellaneous other category. It really does need to be, I think, set forth separately. And so that is what Schedule C looks like. Now, as you're preparing returns as part of your homework, I find that students will often fall into the trap of really just trying to fill out the form. And what I would like you to take away from this class is not how to fill out a form, but it's an understanding of the tax law and what is being asked of, in this case, a business owner, and how that calculates into what ultimately the owner will be taxed on, which is the net profit or loss. So as I said, the net profit or loss is what the business owner will pay federal income tax on. But for any of you that get a regular paycheck, you know that you have to pay more than federal income tax, and what comes out of your paycheck is certainly much more than federal income tax. You have your Social Security tax, your Medicare tax, and just because somebody is self-employed doesn't mean that they get out from under having to report and pay those as well. And so a self-employed individual that has net earnings of $400 or more has to pay that self-employment tax. And so that Social Security and Medicare tax, that will get recovered on Schedule SE that gets filed with Form 1040. And so the individual will have to pay 12.4%. And at this point, and this is a number that changes annually, but right now on the first 132,900, and then 2.9% on Medicare tax. Now, hopefully you remember from Accounting 1 that what gets held from an employee's paycheck for both Social Security and Medicare is nowhere near this amount, and that would be true. So in fact, what the employees have withheld in a regular employment situation is half of this, because then the employer in a regular job has to pay the other half. Well, when someone's self-employed, they get to pay both halves. What would have been an employee's share plus the employer's share. So they get hit twice as hard for the self-employment tax. And they will get a little bit of a deduction for it, but not enough to offset the fact that they're really paying more than they would pay if they were working for an employee and making identical wages. Now, the inventory section we looked at, and inventory can be calculated under different methods, FIFO and LIFO. If you use LIFO, last in, first out, for tax purposes, you also are required to use that in the preparation of your financial statements that are prepared not for tax purposes. In terms of, and the top section of the Schedule C asked whether you were a cash basis taxpayer or an accrual basis. If you are using inventory, you have to be accrual basis. And I'm going to stop here, and the next slide will pick up, or the next video, I should say, will pick up with transportation.